This TFMR podcast is brought to you by your friends at JM Bullion. Visit jmbullion.com for all your gold and silver bullion needs. Welcome back to your TF Metals Report weekly podcast summary. Again, these are just snippets of our daily podcast, which we post every day for subscribers, usually by about 5 or 6 o'clock Eastern Time in the U.S. It's a great summary of what took place that day and a little bit of what you might have to come in the days and weeks to follow. This week began with a market holiday in the U.S., so there was no trading and no commentary from Monday, January the 18th. But picking it up on Tuesday the 19th, one of the topics we discussed were the importance of real or inflation-adjusted interest rates and what they mean for the gold price. It's one of the tightest correlations you will find. As real rates go down, the gold price often goes up. So we begin the week with a discussion of real interest rates. And again, what's important to understand about real yields is the correlation with the gold price until about November the 9th. Well, actually, until about August the 6th. But anyway, I thought I would run this chart. This goes back to March the 20th. Right? The day QE infinity began. And you can see the tip as a blue line and the February gold in candlesticks. Again, moving up hand in hand, hand in glove, whatever you want to call it, all the way until, middle of August, And then gold, after getting slammed with its first $100 candle back on August the 11th, gold continued to trend downward because that's what the banks wanted, while the tip was kind of downward. Then they reunited back there on November the 6th. And everything basically has gone up since November the 6th and the vaccine news on the 9th. Stock market, copper, crude, the dollar's gone down, everything except gold, which again got its second $100 candle as the banks are desperate to maintain this downtrend. And now here we had the other third one 2 weeks ago. Either way, if these two link back up, and they invariably will, because this is the best long-term correlation for gold prices you're going to find. Well, if the tip just goes sideways from here, gold's got to rally about $250 to catch up. Maybe they just meet in the middle. I don't know. Maybe inflation expectations totally evaporate in a bout of illiquidity and deflation, and the tip falls down to gold. Yeah, it could happen too. But I don't think that's how it's going to work. That's not what the Fed wants. So again, this is telling you there's a lot of room to catch up still in the gold price. We spent some time discussing price on Wednesday, January the 20th, but one of the things we focused on was silver. The chart looks terrific, looks much better than gold. And consequently, the junior silver miners are performing much better than the junior gold miners. So here's just a little bit of what we discussed that day. Okay, silver, I left, the flag off because we're broken out. Really, it's still just all about this range, okay? Notice, though, different from gold, how bullish looking this chart is. Again, yeah, we're in a range, all that kind of stuff. But in terms of moving averages, look at that 50-day is only, 16 cents below the 100-day, right? And again, as we get deeper into this month and early February, these trades in late November that are in, these closes from 24 down to 22 are going to come off. And all the closes are going to be between 24 and 28. Well, that's going to draw that 50-day up closer to 26. And that's going to move it up through the 100-day. From there, we're going to start talking about 28, and people are going to start getting really excited. Again, that silver chart looks so much better than the gold chart, and that explains why the junior silver miner chart looks so much better than the junior gold miner chart. And let's just finish with those. I got kind of hung myself out to dry a couple of weeks ago because I still have all of my calls on the Silge. They're due to expire in 4 weeks from Friday. So I got to get pretty nimble here because I don't want them going to zero, obviously. What I'm holding out for, and I was thinking this as it broke down, is a move back up towards 16. I put a red line on here at 16, so you can see the significance of it and how many times since August it's gone up above 16, slam back, above, slam back. You could, 4, 5, 6, 7 times? Then it finally got above 16, went to new highs, and then got smashed back. Well, now here we go again. I can easily see this going back to 16. And then, people say, well, there's a little bit of a head and shoulder there and the real short term and all that jazz. But again, look at the bullish configuration. 50-day the red line, above the 100-day the green line, both above the blue line, still generally sloping higher. Neutral RSI. I like my chances of 16. Thursdays at TFMR are often reserved for what we call our Thursday Conversation, which is always a free public podcast where we bring in some of the biggest names in precious metals and hear from them directly. This week, our focus remained on the mining shares, and our guest was Mickey Fulp, the mercenary geologist, and it was great to hear his independent thinking about where the shares are headed this year. The full interview is posted to the TF Metals Report homepage. I encourage you to go there and give it a listen. But for now, here's just a bit of what Mickey had to say. Anyway, let's talk about copper because it's 8-year highs, right?
I'm very bullish on copper. In fact, of all the metals, I don't really know where gold is going to go this year. We know that with all this fiat creation and the Fed policy and buyback of corporate bonds and modern monetary theory, which is simply pseudoscience in my opinion, that gold will do well. I can't tell you when. Copper, I think, and it's basic fundamentals. The world uses 3.4% more copper and has yearly annualized since 1900. So there's a dearth of developable high-grade copper deposits. So that's the choice. And then zinc and nickel have been following the chart of copper for the last 6 months. Pull up a 6-month chart of copper and then overlay zinc and nickel on it. Now, nickel's going to be much more volatile because it's a much smaller market. It's only, doing the math in my head, and I'm usually pretty good at doing that. So about 15 times less nickel mined every year than copper. So as a result, it's more volatile. Mm-hmm. But bullish on the base metals, and if the Biden administration follows up with what they say they're going to try to do, which is infrastructure build out, which mimics what China is doing right now, that's extremely bullish for the base metals.
And on Friday, January 22nd, we've had another day where price was walked lower during the London session, only to recover a little bit on the COMEX in New York. But unfortunately, it looks like we will finish the week not only below 1860, but also below that 50-day moving average. A good week, nonetheless, but still not a breakout yet. Now, so next week, what will we see? We've got COMEX options expiration on Tuesday. We've got the February gold contract going off the board on Thursday. And in between, the important and potentially consequential January FOMC meeting that will conclude Wednesday at 2 o'clock Eastern, and a press conference with Chief Goon Powell will follow at 2:30 Eastern Time. That'll be the main event, no doubt about that. And maybe next week we'll finally get that breakout from the bull flag and really get things underway again. But much of it will hinge upon the FOMC on Wednesday, so I suggest you pay close attention that day. I also suggest you let TF Metals Report be your eyes and ears for all of this. It's just 50 cents a day or about $15 a month. Come join us. TFMetalsReport.com. You'll get these podcasts every single day so that you'll know exactly what has taken place and what might be coming up in the day ahead. Again, TFMetalsReport.com for all your precious metals news and opinion.